We have the Fed Beige Book headlines crossing right now. A couple of the headlines that are noteworthy here is that the U.S. economy is expanding at a moderate pace with tight labor market conditions and rising input costs, partly due to trade disruptions. So a lot of concerns here are certainly about the trade rhetoric and the trade war and how it's playing out in the different regions that the Fed tracks. But this Fed survey indicates that there is some rising input cost concerns here for the Federal Reserve and for folks around the districts. They do see some increase in inflation pressures. The price rise is seen as modest to moderate in most districts. So we hear those words a lot used, Caroline. Yeah. Modest to moderate. Certainly when you look at the wholesale inflation numbers that came out today, they were a little bit on the softer side, certainly not as hot as some people had anticipated. You're looking at the two-year yield pretty much unchanged as we get these Beige Book headlines. Yeah. In terms of the other parts of the economy, according to the Beige Book, the economy expanded at a moderate pace through August, and all districts noted widespread input price pressure. So again, that focus there on what the trade rhetoric has done to prices is top of mind here, but the economy seems to be doing well. Tight labor market conditions. We'll continue to see how inflation plays out here in the markets.
And whether indeed the trade war has as well. Scarlett, thank you. Now, of course, let's dive deeper into the market action. Our reporters are standing by on equities, bonds, currencies, commodities, you name it, they're on it. Lisa, what are you watching?
Well, I want to follow up on what Scarlett was talking about. The Fed seems to be worried about rising input prices, and yet earlier today when we saw the producer prices, they unexpectedly declined for the first time in 18 months. This was the August reading, and the question is why, especially given some of the trade tensions and the fact that input prices should be rising. The answer may lie with the dollar. The dollar does appear to be strengthening, increasing the purchasing power of companies as they go out and buy things. This will increase the trade deficit but keep a cap on how much inflation there is. This is important to keep watching because what you're looking at here, the white line is the producer price index that is carefully watched by the Federal Reserve. And then that is paired with Fed rate hikes and the Fed just target rate. And you could see it climbing pretty much in tandem. So definitely interesting to see these sort of dual pressures here with prices that are sort of capped as companies export and import more from countries with weaker currencies.